What if the pattern that has crushed every great empire isn't a curse, but a warning label? History insists there are 7 stages: dominance, overreach, deficits, debasement, inflation, loss of confidence, collapse. 4 empires walked that road: Rome, Spain, Britain, and the United States, so the story goes, is already on it. But what if there's another turn in the road? What if the US doesn't ignore the pattern, but breaks it, not by magic, not by denial, by choices, by design? By paying a price early so we don't pay a bigger one later. Here's the tension. The pattern is simple. The math is brutal. You cannot spend forever. You cannot print prosperity. When confidence dies, currency dies. And when currency dies, power follows. If that's the script, the ending looks fixed. But between stage 5 and stage 6, between inflation and a full loss of confidence, there is a narrow window. A moment where policy, productivity, and political will can bend the curve. It has happened before in smaller ways. It can happen again at scale. The stakes are not abstract. If we bend this curve, your mortgage, your wages, your savings, your job market, your daily life will look different than every doomer forecast you have heard this decade. Let's be clear on the map. The 7 stages exist for a reason. Stage 1, dominance. The military is strong, the economy deep, the currency trusted. Stage 2, overextension. Commitments multiply, promises expand. Bases and benefits grow faster than revenue. Stage 3, deficits. Temporary at first, then structural. Stage 4, debasement. If taxes and borrowing cannot cover the promises, the printing press fills the gap. Stage 5, inflation. Prices rise, expectation shifts. The public feels the squeeze before the elites admit the problem. Stage 6, loss of confidence. People and nations no longer trust the unit of account. They prefer goods, gold, or other currencies. Stage 7, collapse. The system breaks, credit seizes, power dissolves. Where is America today? We sit between 5 and 6. Inflation cooled off the peak, but the expectations battle isn't over. Debt is high, deficits remain structural. Global reserve share has drifted lower, even if liquidity still favors the dollar. Military and entitlement promises stretch decades into the future. It looks like the script. It feels like the script. And yet, this is the window. Because once confidence breaks, options shrink. Before it breaks, the list is longer than you think. So let's ask the uncomfortable question that keeps getting waved away. Have nations faced a wall and chosen pain now to avoid ruin later? Yes, not often, not easily, but yes. And those examples point to the only paths that matter. Look at the United States in the early 1980s. Inflation wasn't a headline, it was a habit. Prices had climbed, then climbed again. Wage contracts expected it. Markets priced it. The only way out was to shock expectations. Monetary policy turned hard. Real rates went positive and stayed there. Credit tightened. Growth slowed. People paid a price. Lost jobs, failed businesses, bankruptcies. It was not painless, it was decisive. Expectations broke. The lesson is cold and simple. You can't negotiate with inflation. You break it or it bends you. A nation that accepts a sharp, disciplined recession can salvage the credibility of its money. Pain first, stability later. Now look at Canada and Sweden in the 1990s. Different systems, same problem, chronic deficits and a credibility gap. They didn't fix it with slogans, they rewired the budget. Programs were cut, transfers were redesigned, taxes were simplified, rules were written down and enforced. The state shrank in some places and focused in others. Growth returned, debt to GDP stopped climbing and started retreating. Markets noticed, borrowing costs fell. The lesson there is surgical. If your deficit is structural, only structure fixes it. You don't drift out of a hole, you climb. There's a third case, less dramatic but just as instructive. The US after World War II. Debt to GDP was heavy. The country did not default. It did not debase openly, it grew. Productive capacity exploded. The baby boom met the factory boom. The interstate was built. Universities produced scientists and engineers. Some financial repression helped, but the headline is simpler. Productivity outpaced the burden. When output per worker rises for a decade, yesterday's debt becomes small relative to tomorrow's economy. It's not painless. It is possible. 3. Near-miss case studies. 3 common threads. First, credibility is everything. Second, rules that outlive political cycles are the only rules that matter. Third, productivity is not a press release. It's a flywheel. Once it turns, math bends in your favor. So if the United States intends to break the pattern, it needs ramps. Escape ramps off the road that ends in stage 7. There are only 3 that count. Ramp 1 is the hard one with the fast payoff. A Volcker 2.0, not copy-paste from 1981. But the principle is the same. You make real interest rates positive. You keep them there long enough to destroy the idea that inflation will always come back. You accept a shorter, sharper downturn so households and firms reset expectations. You stop treating price stability like a flavor of the month and treat it like the constitution of the economy. The cost, job losses in the short run, asset repricing, political fury. The benefit? The unit of account regains credibility. Long bonds price a future again. Stage 6 loses oxygen. You have not solved your deficits. You have bought time to solve them. Ramp 2 is the long one with the compounding payoff. A productivity supercycle. The slogans are cheap. The work is not. You scale artificial intelligence where it actually moves the needle. Logistics, material science, drug discovery, software agents that erase administrative waste. You marry that to energy abundance, power that is cheap, reliable, and dense. You don't offshore the hard stuff, you reshore the strategic core, chips, critical chemicals, components for defense and health. You streamline permits that now take years and compress them to months without sacrificing safety. You train a mid-skill workforce that can run a robot cell, not just a cash register. This is not wish casting, it is capital expenditure plus patience. The cost? Massive upfront investment, local resistance, policy stability measured in decades, not news cycles. The benefit? Nominal growth outpacing the effective cost of capital, wages rising with output, debt to GDP declining because the denominator is finally alive. Ramp 3 is the quiet one that unlocks the others, a fiscal grand bargain, not a press conference, a statute with teeth, a multi-year cap on primary spending. Entitlement formulas that recognize longer life and different reality. Sunset clauses for programs that were born as emergencies and never died. Procurement reform that buys results, not paperwork. A tax base that is broad, simple, and harder to game. An independent scorekeeper with the power to force mid-year adjustments when targets are missed. The cost, political pain, lobby blowback, 1,000 headlines. The benefit? A primary surplus that bends the curve of debt, credibility that lowers the rate we pay to borrow. Space for the private sector to deploy capital without fearing a tax ambush next quarter. One ramp rarely works alone. A Volcker-style reset buys credibility. Productivity growth sustains it. A fiscal bargain locks it in. Together, they are not a miracle. They are a plan. But there are 2 levers almost nobody wants to talk about, even though they might be the fastest way to tilt the math. The first is immigration, specifically the quality and composition of inflows. If you want a productivity supercycle, you refill your bench with builders, entrepreneurs, researchers, skilled trades, nurses, teachers in STEM. You build a pipeline that finds talent, moves it quickly, and integrates it into communities that are already growing. This is not charity, it is math. More skilled workers, more business formation, more patents, more exports, more taxes paid into a system that needs them. A nation that selects for skill and drive doesn't just import people, it imports future GDP. The second is a balance of power dividend. Global supply chains today pay a risk tax. Insurance premium no one itemizes. Shipping choices distorted by politics, you reduce that by rewiring the map with allies. North America plus trusted partners in Europe and Asia, shared standards, shared infrastructure, shared emergency buffers for energy, semiconductors, and medicines. When your suppliers are less likely to be shut down by a headline, the supply shock part of inflation fades. Prices become calmer, planning horizons get longer, investment grows. Now, objections, plenty, and they matter. You might say, politics will never allow it. Maybe not, until crisis makes refusal more expensive than reform. It happens. The 1980s did not begin with a consensus to cause a recession. The consensus formed after the alternative failed. Paine clarifies, you do not need unity. You need enough votes to pass the rules and enough courage to enforce them longer than one election. You might say AI is hype. Some of it is. But productivity growth has always come from making the same worker do more with less friction. From the steam engine to electrification to software. If AI fails to raise productivity broadly, the fallback isn't fantasy, it's harder medicine. The monetary reset gets tougher. The fiscal bargain gets sharper. If the wind is weaker, you row. You might say, de-dollarization is destiny. The dollar can lose share and remain dominant. Depth and rule of law matter. Liquidity matters. The ability to move trillions through a system without breaking it matters. If the dollar keeps those edges and if price stability returns, share can slide without a loss of command. Dominance is not a trophy, it is an ecosystem. You might say, this is too slow. That is the point. Quick fixes right the pattern, slow fixes bend it. So what does the next decade look like under three futures? In the first, we take the hard reset up front. Monetary policy errs on the side of discipline. Fiscal policy actually cuts where it must. Growth stalls for a year, maybe two. Unemployment rises, markets shudder and then settle. By year 3, inflation expectations are anchored again. Credit spreads are rational. Investment resumes with a longer horizon because investors believe the scoreboard again. It is not a boom, it is a foundation. 10 years out, the debt burden is lower relative to GDP because the nation accepted pain early and got stability in exchange. In the second, productivity wins. Energy becomes predictably cheaper per kilowatt hour because we built. AI is not a toy, it is a tool in every back office, lab, and warehouse. The United States distributes industry so supply shocks in one port don't freeze the nation. Exports rise in sectors we thought we had ceded. Wages grow without a price spiral because output grows with them. The central bank doesn't have to be heroic, it can be boring. Investors price risk normally. Families don't check the grocery bill with dread. The empire doesn't strut, it works. In the third, we stall, we jawbone inflation, but we never truly kill it. We nibble at the deficit, but the structure remains. We announce the productivity future, but we do not build it. Stage 6 doesn't crash into us, it leaks into daily life. Confidence phrase, the world keeps dollars but trusts them less. Borrowing costs rise for reasons no one can quite pin down. Growth limps, politics sour. The pattern doesn't end the empire, it erodes it, year after year after year. Which future is real, the one we choose? The pattern is not a prophecy, it is a pressure, it forces decisions, it punishes delay, it rewards credibility, structure, and work. So if we are serious about breaking it, we get serious about 3 words: rules, build, and earn. Rules. We write the fiscal and monetary guardrails in a way that outlasts the argument of the day. We stop pretending that a goal without teeth is a plan. We set targets that bite when they are missed. We protect the independence that makes a currency worth saving. Build. We build power plants. We build fabs. We build transmission. We build housing where the jobs are. We build training programs that don't treat a 4-year degree as the only door to a decent life. We build the pipes that carry energy and data because productivity is physical before it is digital. If permits are the bottleneck, permits are the reform. Earn. We earn the world's trust, not with speeches, with conduct, with contracts honored, with courts that work, with budgets that add up, with an ability to argue fiercely and still pass the laws that keep the system predictable. There is a reason to do this beyond charts and bonds. It is cultural. A nation that stops treating money like a trick and treats it like a promise changes its posture. A worker who believes next year's dollar is worth roughly next year's dollar will save. A business that believes the rule won't flip this fall will invest. A city that believes it can get a transformer delivered before the decade ends will expand. Confidence is not a slogan, it is the daily act of planning. None of this asks you to believe in miracles, it asks you to pick your pain. Do we want 2 years of hard medicine or 10 years of slow decay? Do we want a currency that commands respect or a currency that needs excuses? Do we want to watch the pattern like a spectator or rewrite the last pages while it still matters? History is not kind to empires that wait. Rome waited and pretended. Spain waited and borrowed. Britain waited and devalued. The United States still has something the others ran out of: time, scale, and allies. We also have something the others wasted: warnings. Here's the simplest way to think about it. Stage 5 is inflation. Stage 6 is a confidence break. The bridge between them is credibility. Credibility is built by rules, by visible discipline, by growth that isn't faked. You can't tweet it into existence. You can't forward it. You live it. Policy by policy, quarter by quarter. What if the US breaks the pattern? Then the headline 5 years from now won't be collapse. It will be quieter. Boring even. Inflation that stays tamed. Deficits that are shrinking relative to GDP. A power grid built out instead of argued about. A semiconductor base that didn't require a crisis to assemble. A budget process that looks like arithmetic instead of theater. A labor market that welcomes builders, teachers, nurses, and coders from anywhere because we had the courage to say, "Help us grow," and the confidence to absorb them well. And if we fail, the pattern has an ending ready. It is not sudden, it is not cinematic. It is a decade of almost fixed, almost built, almost agreed, until the world decides almost is not trust. That is how stage 7 arrives, not as a blow, but as a shrug. So choose. Which ramp is even plausible where you live? Is a disciplined monetary reset politically survivable? Can your city welcome the build-out that productivity requires? Would you trade a program today for a healthier budget tomorrow? These are not national questions only. They are personal. Every community votes on them with its actions. The pattern is not a curse. It is a scoreboard. If we hate the score, we change the game plan. We do it with rules that outlast tempers. We do it by building the parts of the economy that actually make things cheaper, faster, better. We do it by earning trust at home and abroad, not by demanding it. If any of this gave you a different lens, say which ramp you believe in most: 1, 2, or 3. In the next video, we'll open the hood on the productivity supercycle, where AI, energy, and reindustrialization actually change the math for a country and for a household like yours.